Statements for loan applications. Many builders don't understand loan procedures or how to produce statements for lenders. This chapter shows how to prepare for requesting a loan, what documents you need, and crucial lending procedures every builder should know. In addition, this chapter introduces the Small Business Administration and its services for builders. Loans are available if your approach is correct, and if you can document your need for the loan and your ability to repay it. What is a loan? You're buying money when you take out a loan. Your payments are broken down into two parts. 1, principal, or the money borrowed. 2, interest, the cost of borrowing the money. Because different banks have different lending policies, the cost of money varies from bank to bank. This variation may not be great, but it can make a difference of hundreds or thousands of dollars over the term of the loan. For example, the difference of 0.5% on a 10-year loan for $30,000 is about $8.35, or just above $1,000 over the life of the loan. That's why it pays to shop around for a loan. The availability of money affects the interest rate. More money is available at some times than at others. This availability is affected by the economy, inflation, unemployment, government programs, and the bank's investment markets. If the bank can invest its money in other investments that earn 12% interest, it won't be as willing to loan the builder that same money for 9%. But if the going rate for consumer loans is higher than any other readily available investment, more money will be available. Loans as investments. A bank views a loan as an investment. It allows consumers to use its money for a certain length of time. The builder pays interest on that loan, producing a yield to the bank. Of course, some of the bank's loans aren't collected and become losses. The amount of interest charged on loans takes these losses into account. Builders, especially modest-sized operations, have trouble finding loans because contractors fail in business at a higher rate than many other businesses. These failures are usually a combination of poor management and misuse of capital. For a builder to get a loan, you must do more than show the lender you're the best craftsman in town. You must convince the bank that you can control costs and expenses, produce a profit, pay back the loan with minimum strain, and maintain a healthy business status with the proceeds from the loan. The loan won't be granted if the bank concludes that it won't help your business. After all, the bank must have the highest confidence that its customers can keep up their monthly loan payments. Here are some of the personal and business characteristics you must be able to demonstrate to the bank if you want to be considered a good risk. Your business is healthy. There is no management problem, and funds are controlled constantly. The loan is needed. The loan payments will not cause undue financial strain. The loan itself will generate higher cash flow and increase profits. All the above make a good impression on banks and help show that you should get the loan you want. Specifically identify the purpose of the loan. Working capital is often given as the purpose, but this doesn't really spell out what you'll use the proceeds of the loan for. More accurate descriptions might include to purchase heavy equipment or to prepay materials for upcoming contracts. Make your explanation complete. Demonstrate how the loan will help you generate income. Following are 2 typical kinds of explanations. 1. For heavy equipment purchase, the company currently charges $17.50 per hour in estimates using our old equipment. The current vehicle produces about 25 usable hours of work per week, as it is often out of commission for repairs. With the new equipment, work can proceed at about twice the present speed, and the equipment will be usable for over 30 hours per week. This should enable us to reduce our hourly charge and compete for contracts at greater savings. For prepaying contract materials, we will lose on an upcoming contract about 8% of our material costs due to limited cash flow from lost discounts and quantity price breaks not currently affordable by the operation. A well-timed series of materials purchases would produce materials to be used over the next 4 months of construction. The interest on such a loan would equal about 1/2 of our savings from discounts and price reductions for quantity purchases. The loan can be repaid within 90 days from the installment payments on the same contracts. Explanations should be in plain English. Use common sense reasoning. Vague explanations don't describe the exact purpose of the loan or how you expect to save money. Such applications are likely to be rejected. Some loans aren't needed, and the bank does you a favor by turning you down. The builder who would have trouble making loan payments doesn't need a loan. First, tighten up controls over cash flow and improve management techniques. Then, and only then, should you apply for a loan. See Chapter 22 for guidelines. Loans as profitable decisions. When you approach the idea of borrowing money from the bank, what's the first thing that comes to mind? Most people wonder, I get the money. They may need the money to solve a problem, like buying equipment, paying off other debts, or getting through a slow season. But there's another important way to view the borrowing process. You should be able to show this will be a profitable loan. That means the cost of borrowing the money will be exceeded by the profits you'll make using that money. You need to prove to yourself and the lender that the borrowed funds will be used to generate sales and profits. If you can't, then you should find another solution to your money dilemma and not borrow money. In looking at your loan, the lender will want to know whether or not you're a good risk. That means you'll make repayments on schedule and you won't default on the loan. A good risk is revealed in an excellent credit history and strong capitalization of the business. A bad risk is a business owner who goes to a lender to solve problems of undercapitalization or inability to manage cash flow. If the lender sees that the loan may be a short-term answer to a long-term situation, that loan is generally turned down. If you prove to the lender that the loan will generate more profits than it costs, that's a substantial reason to grant your request. It shows your awareness that borrowing money is a form of capitalization in your business, not a way to bail you out of a bad situation. Too many people have adopted the attitude that a penny borrowed is a penny earned, but that's not true. Excessive borrowing has a terrible effect on your operation. The continual erosion of cash flow from required repayment schedules and the reduction in income from interest repayments can take down a business faster than any cutthroat competitor. A responsible approach to borrowing money requires a repayment plan and carefully scheduled use of funds. The bank or other lender isn't in the business of financial counseling. They literally rent money to qualified customers. They also expect to be repaid. You can succeed in borrowing if you take the approach that a loan is a temporary bridge in your overall capitalization plan. Loan applications. Most banks have their own loan application forms. The two types of forms are personal and business. You'll absolutely be required to complete a business financial statement, although the bank may additionally require that you include a personal financial statement as well. Most bankers require all or most of the following information in the application package: the loan application form, an income statement for 1 full year, a current balance sheet, a cash flow projection for 1 year, a federal income tax return for the previous year. Explain as much of the financial statements as necessary to provide complete information. A typical explanation would include the following: amount of current accounts receivable, the last physical count of inventory, and the method used to value it, due dates on retainage, the accounting method used for sales and costs, expenses, the anticipated profits and duration of contracts in progress, and the expected new business during the coming year. Details on all accounts such as prepaid assets, refundable deposits, and organizational costs. Details and aging of accounts and taxes payable. Monthly payments and payoff dates for all existing loans. Form of organization and identity of owners or principal stockholders. Sales history for the past 3 years, as well as gross and net profits in the same periods. Depreciation methods used and the remaining useful life of equipment. Explanations of any unusually large cost or expense items. Comparative cash flow and net profit statements, with and without expected loan proceeds. Equipment use and estimated hourly costs. Discount and price break policies of major material suppliers. A labor force breakdown. Hourly rates by job classifications, numbers of foremen, journeymen, apprentices, and so on. Any additional financial information is helpful. If you've had an audited financial statement in the past year, you may wish to include that statement and the accountant's analysis of it, even though the statement may not be the latest one available. There's no such thing as giving too much information when you apply for a loan. The banker who reviews your application can't possibly learn all about your business in a brief analysis, so give him or her as much valid information as possible. Presenting data to lenders. Imagine being a loan officer at the local bank. A builder approaches you with a loan application. The financial statements have been scribbled on a yellow pad, no explanations are attached, and the application is incomplete. Your first reaction, based entirely on appearances, is to reject this request for a loan. Obviously, little care was taken in preparing for the application. How can you judge this person as a good credit risk? But assume that the application and the statements are complete, neatly typed, and supplemented with concise, readable notes. These notes are cross-referenced to the statements themselves. A cash flow projection and a short summary of sales and profits for the last 3 years are included. You can now tell a lot about this operation. More important, the owner has taken some time, made your job easier, and has ended up with a concise summary of facts. You know from experience that this person is likely to be as well organized in all his or her affairs. You might conclude that this must be a well-organized shop with effective management to produce such well-defined material. You must deal with individuals and banks, and final decisions are made not only on the material presented, but in the manner of the approach, and even on personal appearance. One banker may be totally objective and look only at the documented facts. Another banker may turn down a loan application because the builder wasn't well groomed. Banks insist that all loans are given a fair review, but they also admit that their loan officers use a good amount of personal judgment and weigh all factors in considering loans and loan applicants. Most banks will gladly help the builder complete the application correctly. Each bank asks its own questions, and these aren't always easily understood. Most applications require a financial statement to be completed on the form itself. The best approach to this is to fill in the form completely and attach a typed financial statement with notes. Very often, the format of a bank's loan application isn't as informative as your own statement, and there may not be enough space to include full notes. There's no room for a comprehensive cash flow statement on most applications, or for any extra worksheets or detailed historical data. Prepare a good list of credit references, complete with addresses and phone numbers, and a short description of your credit history with each person or firm. Co-signers and guarantors. Banks are sometimes willing to grant loans on the condition that the applicant get a co-signer or a guarantor. A co-signer is a person whose credit is well established and who can vouch for the builder's ability and reputation. The bank usually requires co-signers for young adults or minors, and for people without a long business record or their own credit references. A guarantor is similar to a co-signer, except that a guarantor actually promises to pay back the loan if the borrower doesn't. This person will be liable for the balance of the loan if you default, and the bank would expect payment from the guarantor in such cases. The largest guarantor of loans in the United States is the Small Business Administration. The SBA was formed to encourage free enterprise, and it acts to help small businesses obtain financing. A. Small Business Administration. The Small Business Administration is a government agency originally formed to help small business owners by offering a loan guarantee. The SBA isn't in the primary business of lending money to businesses. It most often works with small business owners to find loans in their communities and guarantees repayment on behalf of the business. The SBA is a substantial resource for builders. It was formed in 1953 to provide financial, technical, and management assistance to business owners. For most business owners, the interesting part of SBA service has to do with helping to get loans. Today, SBA is the largest financial backer of small businesses, with a total of $45 billion in loan guarantees, plus venture capital investments of another $13 billion. According to their report of August 1, 2000, SBA helped over 1 million small business owners. The SBA is a valuable resource for small business ventures. By SBA definition, a small construction firm has annual sales up to $17 million and fewer than 100 employees. This covers the majority of companies. SBA states that there are 25 million small businesses in the U.S., and these employ more than half of all workers and make up more than half of the gross domestic product. That's an impressive statistic. To help this large group of businesses, SBA offers a variety of loan programs and guarantees. One of the most popular is called the 7th Loan Guarantee Program. Under this program, loans are granted to small businesses that can't get loans through normal channels. SBA doesn't make the loans itself. Rather, they work with local lenders who grant the loans. The SBA guarantees repayment, so the lender's risk is practically nil. SBA has defined 5 so-called Capline loan programs. These are short-term working capital loans for small businesses. They include seasonal line. These are advances tied to seasonal changes in working capital, specifically accounts receivable and inventory. Contract line. This is intended for financing direct labor and material costs. A builder's line. If you're involved with renovating buildings, the project is used as collateral for the financing of labor and material costs. Standard asset-based line. This is a revolving line of credit secured by your assets. It helps achieve growth by providing draws during cyclical, short-term slow periods, with repayments taking place in high cash volume periods. Small asset-based line. This is a revolving line of credit up to $200,000. It's similar to the standard asset-based line, but waives some of the requirements for repayment, providing more flexibility. There are no specific maximums applied to SBA guaranteed loans. However, the most that the SBA can guarantee is $750,000. It's possible to get a larger loan, with the lender assuming a portion of the overall risk. For example, you could request a loan for $1 million with a 75% guarantee from the SBA. Eligibility for SBA programs. Are you eligible for an SBA guarantee loan? The SBA applies 4 criteria, although almost all small businesses are eligible. The criteria include the type and size of business, use of loan funds, and special circumstances. Type of business. Most businesses are eligible for assistance from the SBA. Your business must be operated for profit. Your offices must be within the United States and its possessions, and be doing business in the U.S. You must have a reasonable degree of owner's equity in your business. Size of business. An eligible small business is defined as one that is independently owned and operated and not dominant in its field of operation. The definition varies by industry. Construction businesses are defined as small with sales up to $17 million per year. Use of loan funds. Proceeds from SBA guarantee loans can be used for most reasonable business purposes, such as purchasing real estate for business offices and facilities, construction and improvements, acquisition of capital assets, purchase of inventory, and working capital. SBA loan proceeds can't be used to finance floor plan needs, purchase investment real estate, pay the owner's delinquent taxes, or pay existing debts. Special circumstances. Some special circumstances are taken into account. These relate to franchises, holding companies, change of ownership, and resident aliens, among others. If the owner or any principals in the company are on probation or parole, the firm isn't eligible for SBA assistance. The same rule applies for any owners who are incarcerated, or anyone who's currently a defendant in a criminal proceeding. More information on the SBA and its programs can be found on the internet. Their homepage is located at. Details on Capline loans can be found at fullcaplines.html. The prospectus format. Narrative explanations of your operation's history, markets, recent profits, and cash flow can be highly effective presentations to lenders. This type of factual, descriptive presentation is called a prospectus format. The prospectus should be brief, and it should be written honestly, without overstating the facts. Don't ignore the bad to point out the good in your business. Bankers appreciate a totally honest presentation when they review a loan application. The sales promotional, public relations approach to presenting financial information isn't appropriate for loan applications, as bankers aren't sold by glossy, attractive, and slick-written reports. The prospectus is less formal than the columns of figures and pure accounting data that goes in the financial statements. Its purpose is to describe your operation and its functions through brief educational sketches and, in some cases, examples. This format is often used by large corporations when they present their annual statement to stockholders. These elaborate and often expensive projects include a letter from the board of directors, financial statements and notes, and a large amount of text and illustrations to describe the products and the year's successes. But the annual statement type of presentation isn't appropriate for loan applications for small business. These are sales presentations that are carefully prepared to highlight good news and downplay bad news. Although issued by corporations, they're normally prepared by public relations firms who write the letter from the chairman of the board, all the product explanations, and the graphics captions. The modest prospectus format, on the other hand, is a simple 3 or 4-page summary of the company's markets and history. It's informative and meaningful to a banker. It quickly familiarizes him or her with the operation in a way that affects the lending decision. An expensive, hard sell presentation may make the banker suspicious. Why is the builder trying so hard? Forget about elaborate, impressive presentations for loan applications. The most effective presentation combines the best qualities of the accounting and the prospectus methods. 1. Complete set of financial statements, balance sheet, income statement, and cash flow statement. 2. Detailed notes explaining any special circumstances, accounting methods, inventory valuations, accounts receivable aging, sales and profits for specified periods, and the like. Make sure your notes are fully cross-referenced to the financial statements. 3. Narrative description of the company and its markets. Be brief, but include solid, straightforward information. Make the description honest and well-written. Mention both good and bad aspects of your operations condition. It's important to mention both the good and the bad. The accounting approach and the public relations approach to the same narrative description or note may be very different. The accounting approach tends to weigh negative conditions just as heavily as positive financial conditions, while the public relations approach is very often more optimistic. Find a reasonable explanation somewhere in between, which reflects a business-like approach to solving problems and changing negative trends. For example, assume that sales for the past year fell far below previous years and below current expectations. There are 3 approaches you could use. The accounting approach: sales were 25% lower than the previous year. The entire drop in volume was in the bid contract market for new homes. The public relations approach: sales were lower than in previous periods, however. The estimates for next year are promising, as the company is in a better competitive position than ever before. The honest compromise: sales were 25% lower than the previous year due to less activity in the new homes market. This was caused by faulty estimating procedures. A more organized method is now being used. Notice that in the honest compromise, good and bad news are placed together to offset one another. This lets the lender judge the application with all the required information at hand. There's no need to hunt elsewhere for negative conditions or positive trends that offset the note under examination.